Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video we're going to be talking about dividend CAGR and just how important that is to a long-term portfolio, a dividend portfolio like mine is, and I think like a lot of your guys' portfolios are. So we're just going to dive into that and look at some numbers, and I kind of did some simulations, that I can show you of different dividend CAGRs and starting yields, and just projecting out the growth of the account over a long time. And it's pretty crazy to see once you look far into the future, 10, 20, 30 years, the dividend CAGR is super important. So I just want to talk about that because I have been focusing on my portfolio in increasing that dividend CAGR, and we can kind of see the effect of that. We're going to look at that as well. So first, we're just going to look here at what CAGR is and run Investopedia. And the compound annual growth rate, or CAGR, is the rate of return that will be required for an investment to grow from its beginning balance to its ending balance, assuming the profits were reinvested at the end of each year of the investment's lifespan. So basically, CAGR is simply the growth rate on a year-over-year basis that something grows. So in the case of the dividend, that is the growth rate of the dividend each year. So you can look at that in the past. Most of the time you look at in the past. For example, maybe the average of the past 3 years, you would just take the beginning amount of the dividend and then look at the ending amount of the dividend and calculate the CAGR with that formula and come up with that CAGR, and that would say on average the dividend grew this amount each year. So we often use the historical CAGR of some time span to estimate the future CAGR in order to estimate some returns. And right here is the pretty simple formula for the CAGR, and it's basically you just take the ending value and divide it by the beginning value, and then you raise that to the 1 over years, and then that's going to give you like 1.05, for example, and then you subtract 1, and that will tell you the CAGR was 5% in that example. So this right here is just a little spreadsheet I put together pretty quickly just to do some simulations or approximations given some conditions that we're just going to assume are true, right? So basically we have our starting value up here. Here, I'll zoom in a little bit. We have our starting value up here, and then we're going to say what the share price is so we can know how many shares we're starting with. And then I put this in here as a quarterly share price appreciation. So this basically says every quarter the share price is going to go up by 1%, and that is obviously not going to happen exactly at all in the real world, but that's just an approximation and a guess you have to make in order to make this work. And then this is the starting dividend yield of whatever company you have. So if you want to look at a specific company or your overall portfolio, you can just plop that number in there. And then the dividend CAGR is just what it is, the dividend CAGR, and you can use some historical rates from maybe the past 3 years, the past 5 years, the past 20 years, something like that, or you can try to just guess a number based on earnings growth, because that's a big thing as well in comparing the dividend CAGR to the earnings growth. Because if the dividend CAGR is 10% for the past 10 years, but they're only growing their earnings 1 or 2% every year, well, that dividend CAGR really probably isn't going to be sustainable in the long term. So that's something you have to look at as well, and something I really want to cover in a future video. So stay tuned for that one. And if we look right here, this is in my portfolio spreadsheet where I just keep track of some things. And basically what I do is just keep track of some metrics for the portfolio every month, and then that way I can look at that progress over time. And you can see initially back in September of 2020 the dividend CAGR was under 6%. So now at the end of May of 2021 the dividend CAGR is nearing 7%, and I definitely want to get to that 7% and above that 7% mark. So we're going to look at each of those, and then maybe what would even happen if we got to 8%. So also we're going to look at whatever the yield is. So currently the dividend yield of the portfolio, let's see here, it's 2.76%. So that's what we'll put in to our spreadsheet here. So we'll put in the 2.76% for the dividend yield, and it's just a rounding, that's why you're not seeing it there. And then for the dividend CAGR, we're going to put in that number that was, whatever it was initially, 5.95% there. So let's plop that one in, and we'll just put that out a few more decimal points so we can see. And right here on the right are just some selected years that I picked. I list them all out here because that's just what was easiest to do, and then I just pick some and plop those values in. So this is basically starting with a portfolio value of $1,000 and the share price is $100. So if we look here, I did a calculation every quarter. So you can see we're starting at $1,000 for the portfolio and the share price is $100. So that means we have 10 shares. And then based on the annual dividend, that dividend yield, this is going to be our annual dividend, then just divided by 4 for the quarterly dividend. And then this is estimating the annual income given the annual dividend times the number of shares, and then estimating the amount of dividends we're going to get that quarter, and then how many new shares we can purchase. And then we're just going to keep doing that every quarter and adding on those shares. So, you know, the share price after one quarter is going to go up 1% from $100 to $101. And then since we were able to purchase 0.069 new shares, then the next quarter we're going to have 10.069 shares. And that is something that's super important, is that this is all assuming that you're reinvesting your dividends the whole time. So that's something to keep in mind as well if you weren't going to do that, or if you aren't planning on doing that. I would highly recommend you do that if you can. So right here on the right are the results. You can see after 5 years, the portfolio value is at $1,310 and the yield is just under 3%. And then after 10 years, the value's a little under $2,000 and the yield's about 3.25%. At 30 years, the portfolio is almost at $9,000 and the yield's 4.5%. At 50 years, it's at $57,000 and the yield's almost 7%. So you can see how that really starts to grow, and how those dividends just compound and keep buying you shares that are going to give you more dividends as well. But the one thing you got to keep in mind is that, you know, near the end here, it says the dividend yield is 16%. Well, that's really not sustainable, in my opinion, for companies, and that's just not going to work over the long term, because that's basically saying the dividends are growing faster than the share price. Which means you're going to get a higher dividend yield, but if the earnings aren't growing more quickly or as quickly as the dividend, then they're probably not going to be able to keep increasing that dividend. And if the earnings were growing as fast as the dividend, then the share price would probably most likely be increasing a similar amount. So then that dividend yield wouldn't be as skewed. So that's something I'm definitely going to look at in a future video, to try to figure out how to compare those and judge whether that yield is sustainable or that CAGR is sustainable or not. And then also we're going to change the dividend CAGR here to 6.89%, which is the current amount. And you can see just how much of an effect that has. After 30 years, we're at $10,000 where we were at $8,000 before. And then after 50 years, we're at over $100,000 where we were only at, you know, around $50,000 before. So it's really amazing how much that dividend CAGR has an effect in the long term. And you can see the yield is near 40%, which is definitely not realistic, I would say, similar to that 16% at 100 years. And ideally, I think I would like to at least for the next few years get my portfolio's CAGR even closer to 8% probably. So let's look at what that would look like in that case. You know, at 100 years, the dividend yield would be over 100%. But if my CAGR is 8%, my starting dividend yield will probably be a little bit lower. So even if we start that at 2%, what is pretty interesting to me is the numbers are pretty similar with the 2% yield and 8% CAGR as they were with the 2.76% yield and the 7% CAGR. So that's just something to keep in mind, that that little bit of CAGR in the long term can have a huge effect. So this was just basically an illustration of why I'm, you know, focusing heavily on CAGR right now and just trying to increase the CAGR as much as possible. Obviously, without sacrificing the sustainability of that CAGR. I do want that to carry forward many, many years. So that's something I'm looking at as well. And I did do another video about CAGR, basically how to import the dividend CAGR into your spreadsheet, because that's not just a simple Google Finance function. So I'll leave a link to that video right up here if you guys want to check that out. I think that would be super interesting for you guys to watch. And I just want to thank you guys for watching to the end of the video, and I'll see you in the next one.